Awesome. So yeah, I'll just dive right in. So as Jamil said, my name's Nick. I'm a business development associate at Compound Labs, which is the team that built the Compound protocol that many of you are probably familiar with. I'll be giving a sort of a high-level overview of the Compound protocol on a sort of non-technical basis, going a little bit on how the protocol works, some of the existing integrations, and what sort of the future of the protocol will look like. So just to start off, the way we view DeFi is an open, intermediary-free infrastructure for a modern financial system. And what we think is really important here is sort of recreating different financial primitives from the ground up to be transparent, efficient, and composable. So if you think of the sort of traditional financial market stack, when you're sending value to an institution, it sort of goes into a black box where you don't really have visibility on where those assets are located, who actually has title to them, and what different parties are transacting with them. And this is in sort of stark contrast to what teams in DeFi are building, where it's all set on open standards. And Compound is one example of a number of different ecosystems building these financial primitives. So in practice, what this looks like are a variety of different primitives, which I'm sure a lot of people here are familiar with. So there's stable coins like USDC and DAI, decentralized exchanges like 0x and Uniswap, risk mitigation and sort of pseudo insurance protocols like Open and Nexus Mutual, and then interest rate protocols like Compound, Aave, or Maker. And we really think the name interest rate protocols is more accurate than lending, which some people are more familiar with. But the concept of lending really involves systems of credit. So you have an actual IOU out to someone where if they don't pay back the loan, then the supplier cannot be made whole. But because most of these interest rate protocols like Compound are over collateralized, there really is no system of credit. We don't think it really is lending. And so it's slightly different than what most people are familiar with lending. And so a little bit on how the composability of all these systems would work in practice is someone could go to a stablecoin protocol, mint DAI. They could send that to Compound, where they would be sent CDAI, which is just the Compound version of DAI. They could take out cover on that position through Open, and then eventually trade those C tokens directly on a decentralized exchange like Uniswap. So that composability between all these different systems we think is really powerful, where you're never having to sign up with a contract or get approval. As long as you have a connected Web3 wallet, you can do all of these interactions instantly. So a little bit on Compound specifically. So the Compound protocol is a set of globally accessible open source interest rate markets for Ethereum assets, where anyone with assets like DAI, Tether, WBTC can supply them to the protocol to earn interest. And rather than in traditional markets where you're interacting with one counterparty and setting up a loan, sort of in a peer-to-peer model, we really view this as a peer-to-pool model where you're just interacting with pools of liquidity that borrowers are then able to borrow from. I think a good description was from the former head of the OCC, Brian Brooks, who called these systems self-driving banks. So if you think about the most basic functions of a bank or any depository institution, they allow for people to deposit assets, earn some form of yield, and then allow other parties to borrow those assets. So this all happens autonomously on Compound through smart contracts, code, and incentives, rather than humans with spreadsheets and proprietary databases, trying to match everything up and reconcile it themselves. So the Compound Protocol was originally built by our team, which is around 13 people based in San Francisco, now much more distributed. But in was April or May of 2020, we launched a governance system and a token called Comp. So the future of the protocol is in the hands of Comp token holders who are able to vote and propose new changes. These changes could be fairly large things like changes to the actual contracts. They could be parameter tweaks. They could be adding additional markets. But the important aspect of this is that the protocol can now operate in perpetuity without our team playing any sort of admin function. So the community can drive the protocol in whatever direction they think is fit. So since launch, the protocol has processed over $50 billion worth of supply volume. Currently has a little bit under $10 billion worth of supply. It broke that $10 billion threshold, I believe, on February 21st. Has come down a little bit with falling asset prices, but still a pretty big milestone for the community and the protocol. There's roughly 280,000 users interacting with the protocol, and it really sort of follows a power law distribution of users. So you have a few large power users who are supplying, tens, if not hundreds of millions of dollars worth of liquidity, and then you have a much smaller or much larger set of users supplying smaller amounts. It kind of follows that power law distribution. There's been over $20 billion worth of assets borrowed, currently around a little over $4 billion of outstanding borrow. And there's currently 9 interest rate markets supported with, probably many more on the way, depending on if the community decides to add more assets. And even in the last year, it's grown quite a bit. So I joined Compound roughly a year ago when the protocol was holding about $100 million worth of assets. So it's been pretty amazing to see just over the past year it go from 100 million to 10 billion. So a little bit on how Compound works under the hood. On one side, you have suppliers who are looking to earn a yield on their assets. So in this case, we have Alice, who holds USDC. She could access Compound in a number of ways. She could go to our interface at app.compound.finance. She could go to a variety of interfaces that different companies have built, like exchanges or custodians or consumer savings applications, or she could access Compound's yield programmatically through an API. But at a high level, she'll be calling the mint function to Compound, which will send her USDC into this pool of USDC liquidity. And in return, she'll get back CUSDC. This C token represents her balance and share of the pool. And at any time, she can send back that CUSDC in exchange for her underlying asset plus interest. So what this really enables is a portable interest-bearing account that she can take with her, to her favorite wallet. She can even sell it on an exchange, but creates a really flexible way to kind of hold and trade that yield. On the flip side, you have borrowers who first have to supply some asset. So in this case, we have Bob who's supplying ETH, and then he's able to borrow a certain amount of assets depending on the collateral factor of the collateral that he's supplied. So the highest collateral factor for any asset right now is 75%. So if Bob supplied $100 worth of ETH, he could borrow $75 worth of any other asset. And a use case that we've seen pretty frequently, which is driving a lot of the interest rates for stablecoins, is the demand to lock up a volatile asset like ETH or wrapped Bitcoin, and then borrow a stable asset like DAI, USDC, or Tether. And there's a couple profiles of users who are doing this quite frequently. So there are hedge funds who are looking to lever up on positions. So they could supply ETH, borrow a stable coin, use that on an exchange to borrow or to buy more ETH, and now they're levered up long more than they would be originally. And another use case is from mining firms who are minting ETH but need stable coins to just run daily operations, have liquidity, and maybe not want to incur a tax event by selling their ETH in an adverse market condition. So that sort of drives the demand for and high interest rates for stable coins that we've seen. And the last thing to keep in mind with all these markets is the liquidation mechanism, which really makes sure that the protocol has an acceptable amount of risk. So with those collateral factors that I mentioned, if a borrower ever exceeds that 75% threshold for ETH, like I mentioned, or it's even lower for other assets, I believe 60% for BAT or ZRX, there's an ecosystem of liquidators who are looking out for at-risk borrowing positions. And as soon as they find a position that has exceeded that collateral factor threshold, they can seize up to half of the borrower's collateral, repay their borrowing position, and take an 8% fee as an incentive. So this sort of de-risks the protocol automatically through just open incentives. And there's an ecosystem of hundreds of bots who are constantly scouring the protocol, making sure that all suppliers are made whole in the event that a borrowing position has exceeded its sort of acceptable risk factor. So all the interest rates on Compound are determined by an algorithm, and governance has the ability to set these different interest rate curves. And then depending on the utilization, that'll determine the supply and borrow APY for different assets. So this really kind of targets a certain level of utilization in each market. So you can imagine when liquidity is low, let's say the market for USDC is mostly borrowed out, the interest rate ratchets up really aggressively. So borrowers have a very high cost of capital, and it also incentivizes new USDC suppliers to come in, post liquidity, and then those previous suppliers of USDC can now withdraw their funds if they need to. So the cool thing here is that just through incentives, it's able to ensure that the protocol doesn't have a liquidity crunch where suppliers aren't able to withdraw their initial deposits. So a little bit about some of the businesses that are building on top of the protocol. We really view the main users of Compound as developers. Our team built a interface at app.compound.finance, but we really support and help and celebrate all kinds of developers building experiences and interfaces. And it comes in a variety of different products. Some are exchanges who are typically trying to launch some sort of earn or save feature. You can think of OKX, Binance, OKCoin as examples of this. There are custodian technology companies like Fireblocks and Curve who are providing tools for more institutional investors to earn interest from sort of their secure custody environment. And then there's a whole crop of sort of consumer savings applications like InstaDApp or Argent or Pool Together that really provide intuitive interfaces for users to sign up and earn a yield that's 50 to 100 times greater than what they would get from a traditional bank account. And I wanted to highlight a few of the integrations that we think did a really great job on their user experience and overall offering. One of them being OKCoin, which is an exchange in San Francisco. They let users self-select not only the yield, but the protocol and asset that's delivering that yield. So users can really choose, what risk profile is best for them. It's also very retail friendly in that they pool transactions. So they batch transactions and do one supply per day to compound. So you sacrifice some decentralization in that you're trusting your assets with a third party. But the benefit is that they're able to cover those transaction fees on behalf of their users. So for smaller amounts, this makes a lot of economic sense for a lot of retail users. On sort of the opposite end of the spectrum, we have Fireblocks, who I mentioned a little bit earlier, who launched sort of institutional savings accounts. So from their MPC custody vaults, different hedge funds or banks, financial institutions, anyone who really cares about security and custody, just with a click of a button or with APIs, can supply their assets to compound and earn interest. And they've been pretty successful with this, and it's sort of a very popular way for different money managers to access compound's yield. The last one I'll mention is Pool Together, which is a no-loss lottery system. So users are able to deposit their assets. In return, they get tickets, which sort of represents their share of the pool. And then at the end of a predetermined period, like a week, for example, all of the interest that's been generated on those deposits are awarded to one person, and everyone else gets their principal back. So with this no-loss lottery system powered by Compound, it kind of shows how DeFi is enabling new types of financial products that maybe wouldn't make sense in traditional markets when yields are lower. And also kind of highlights the flexibility of the Compound protocol, that it's sort of just an API for yield, and these different products can enforce their own rules on top of the protocol. So we really think that the next wave of integrators won't really be crypto native at all, but sort of traditional financial institutions who are looking to access the higher yield and use cases that are in DeFi. This is particularly relevant in the past few months as interest rates have sort of plummeted in traditional markets, and these sort of fintechs and neobanks are looking for ways to attract new customers. So we think, over the course of the next couple of years, we'll see a lot of entrants into the market who are comfortable sort of abstracting away the crypto components, managing all this on their users' behalf, and offering kind of the end yield that's provided by Compound and other interest rate protocols. And so the challenge and the opportunity there is really finding a way to bridge fiat accounts with crypto, and do so in a really kind of seamless way where users may not even know they're using crypto in the back end. And lastly, I'll talk a little bit about Gateway, which our team just released a testnet for last week. So Gateway is a reimagination of the Compound V2 protocol on Ethereum that seeks to solve a couple current limitations. One limitation being that high transaction costs on Ethereum have priced out smaller transactions, and the protocol has no way of supporting assets that aren't tokenized on Ethereum. So Gateway is a standalone distributed ledger built on Substrate that really prepares for a multi-chain world by enabling cross-chain interest rate markets. So different L1s can connect to Gateway through what we call starports, basically adding the ability to upload or download those assets onto Gateway, and then be able to borrow other assets that are supported on Gateway. All interest is accrued in cash, and network fees are also paid in cash, which is the standard unit of account on Gateway pegged to $1. So the end goal of Gateway is really to bridge together these what could be sort of fractured liquidity pools on different L1s and connect them all with a cross-chain interest rate market. So yeah, we're excited for kind of this new multi-chain world that could include different L1s, central bank digital currencies, and are excited for users to give feedback and try out the testnet. So with that, I'll kind of turn it over to Q&A, and happy to answer anything on Compound V2 or Gateway.
Okay, Nick, that was a fantastic presentation. We definitely got to get that slide deck out to the masses. We do have a bunch of questions. Let me ask you a kind of a question just for the sake of argument. Now, when I go to the bank, I borrow money. I can borrow money. I can put up a collateral, which basically, let's say, a mortgage, and the house is collateral. But there are cases where I can borrow money from a bank, and there's really no collateral, right? Business loans may not be collateral. Is it the thinking correct that because there is no recourse on a blockchain, therefore you need to have a kind of a cushy loan to value LTV rate of 75%, because if the person is not paying that back, there's not much you can do? Is that the right thinking, or are there other factors that are causing for you to arrive? Because I mean, you're looking at that diagram, money's moving in from one side, but on the other side, there's got to be collateral for borrowing. So can you speak to a little bit around the need for collateral and why, the economic basis for that?
Yeah, exactly. That's a great question. So the need for collateral is really based on the fact that the protocol is all self-driving and does not rely on any trust. So it's designed to, any borrower could sort of just completely walk away from their position, have no intention of paying back their outstanding borrow, and the protocol would be entirely fine because it would be seized by liquidators. So you do sacrifice some capital efficiency, like you mentioned, where, if you build up trust, sign contracts, use a traditional bank, you can borrow with, low to no collateral. But on these decentralized systems, all those rules have to be kind of encoded. So it doesn't really allow for the nuance of trust. And it'll be interesting to see if any teams in the future are able to provide capital efficiencies that are sort of greater than 100%, or like positions would be under collateralized, under 100%. But there are some other incentives that protect suppliers. Because right now that over collateralization and instant liquidation mechanism offering 8% to liquidators keeps all suppliers whole in the event that a borrower just walks away from their position.
Right. Okay. So that kind of leads into a question from the audience, which is, what is your delinquency or default rate among your borrowers? And I'm assuming, because the way that you set it up, it should be low to zero, right? Almost, they're defaulting, but there's no necessarily a loss.
Yeah, so there's never been a supplier of capital has never lost funds on Compound for the entirety of its existence. Borrowers are in charge of sort of managing their own positions. And there's some pretty good Dune dashboards. I'm trying to remember the name. It might just be DeFi liquidations that show, all previous liquidations on Compound and other interest rate protocols. We've seen an average LTV of around 181%. So even though a borrower would get liquidated at around 135, they're providing some cushion and monitoring their position. Right. So I don't know exactly what the delinquency rate would be, but if you use a tool like Dune Analytics, it has all that information.
Right. So there's really two numbers that matter, right? The default rate doesn't matter if the lender is made whole anyway, right? And the collateral seized, right? So I think the question here is really how much has the default impacted a lender? And in this case, the way the protocol is designed, it's over collateralized. So the minute you're approaching this, a thin buffer around the collateral, then it's liquidated, right? And the lender is made whole. Okay, great. Thank you for that question. And then I have another question from Rahul. Could you talk about the liquidity problem faced by decentralized protocols and how Compound fixes it? So I think that was kind of pretty much the entire presentation, but maybe if you can repeat the main points of that.
So I want to make sure I'm understanding it correctly. It was the liquidity issues.
Liquidity problem faced by decentralized protocols. So I'm assuming what this question means is if you've got a token, how do you sell it? If you got something in your wallet, how do you sell it? This is maybe more of an AMM type of a question, but you do have liquidity in the sense that you have lenders and borrowers coming together.
Yeah, so I think liquidity is important for a few things, and it's something that we consider both when adding a new market, or the community considers when adding a new market, and when setting the collateral factor for an asset. So the community has been pretty conservative about adding new assets, particularly because any asset it adds should be pretty liquid, so that in the event of a borrower kind of defaulting on their position, liquidators need to be able to go out and source that token in order to make the supplier whole. So there's a number of areas of liquidity that are important, both on centralized exchanges, DEXs, and that kind of goes into how the community decides how to set parameters for those assets. And the Gauntlet team, which has done a great job kind of analyzing the risk of every different market on Compound, has a new dashboard that kind of scores each of Compound's markets based on its liquidity, its collateral factor, and then how much risk it poses to the protocol as a whole. So I'd highly recommend looking at, I believe it's called their AutoGov dashboard, if you're interested in how liquidity affects risk for the protocol.
Okay, so we have a follow-up on that question from Yuna. The person is saying, I'm trying to understand who your borrowers would be, given that they must supply coin as collateral. For many borrowers, they put up non-liquid collateral, real estate, hard assets, kind of what I was mentioning, in order to borrow liquidity, be it short-term or longer. So the question again is, who would your borrowers be? What's their profile, I guess?
Yeah, so borrowers are typically more sophisticated users than just suppliers. A lot of times they're institutions like hedge funds, trading firms, mining firms, who have sort of large reserves of ETH and wrapped Bitcoin typically, or just Bitcoin, and then they're wrapping it themselves to use on decentralized protocols. But they have access to these large amounts of volatile assets. And for one reason or another, they don't want to sell them, but still want to go and take advantage of other opportunities in the market. So, there's a lot of hedge funds that are very long-term bullish Bitcoin. So they might supply wrapped Bitcoin, let's say like $100 million of wrapped Bitcoin to Compound, and then borrow, a few tens of millions of dollars of stable coins and able to go chase opportunities. Maybe there's arbitrage opportunities. Maybe they just want to lever up on Bitcoin, deploy them in a number of ways. So it really just comes down to locking up.
And your presentation was so great that you are going to suffer through some of these questions. Yeah, great. Any insurance and compensation for suppliers in any case, and I'm just trying to read it, and I might rephrase this a little bit. In the case of liquidity, in the case of theft of liquidity, so when things are hacked or stolen, is there insurance for the supplier, for the lender?
So natively on Compound, no. The protocol doesn't really provide any insurance. there is something called a reserve factor on each market. So the protocol takes a little bit of all interest generated in each market and saves it sort of as an insurance fund. And then governance can decide what to do with those reserves. So, if there was some sort of exploit and governance voted, and let's say it was in like the USDC market, governance could vote to distribute some of the USDC reserves to a list of Ethereum addresses that were affected by the exploit. That's probably the closest thing in the protocol that mimics insurance. Outside of that, there are other options like Open, who I mentioned, Nexus Mutual, which have different types of insurance or cover programs. But for the protocol itself, it's really just that reserve factor that I mentioned, and then it's sort of subject to governance's decision on how to use it.
Right. Thank you. Fantastic. Another question. Do you think DeFi interest rates will remain elevated? And this is from Frank Amato, co-founder of BlockFi. Will DeFi rates remain elevated compared to traditional markets, even after more institutions start to enter?
Mm-hmm. Yeah, that's a great question. I think the short answer is no one knows. I think some interesting things to look at are, I think there's so many different opportunities to deploy stablecoins in DeFi, and the velocity of money is so much higher in stablecoins than traditional finance. And the fact that the borrowing profile is different, in that you don't have to sign up for any agreement. You can borrow instantly as long as you've supplied capital. I think it has just kind of different dynamics than traditional interest rate markets. I think it's been probably a little bit higher than usual in the past week. I think we saw 20% APY for USDC a few weeks ago. Over the last year, it's averaged around 2.94%, not including the automatic comp distribution. But I think we've seen sort of a range between 4 to 8% that's been fairly consistent since Compound's inception. So yeah, I do think it'll be higher than traditional interest rate markets for the foreseeable future. And it's really just kind of yet to be seen how all these markets evolve once more players enter the space.
Okay, 2 more questions and then we're going to wrap it up. There's a Yuna that has another follow-up. He or she seems to really want to know who your borrowers are. Let me read the question. Who are your typical borrowers? And also, do you try to achieve some sort of equilibrium of lenders to borrowers to somewhat match available capital in and out? And I'm guessing some of the algos, that's their job, right? So
yeah, that's exactly right. So it's purely set by those interest rate markets that I mentioned, that are, or interest rate models that I mentioned, that depending on the utilization, kind of target a certain level of liquidity. So if a market is completely borrowed out, the interest rates are insanely attractive to new suppliers. So a flood of new capital comes in. And when utilization is very low, the cost of borrowing capital is very low, and it incentivizes borrowers to come in, borrow those tokens, and likely deploy them for a more productive purpose elsewhere. So the borrower profile is really just sophisticated traders, really, who are looking to take advantage of either low cost of capital for borrowing and deploying them elsewhere, or attractive interest rates for supplying capital. But really it's sophisticated traders, hedge funds, mining firms on the borrowing side.
Okay, fantastic. Last question, and then we're going to move on. What is it like to do biz dev for Compound?
Yeah, so and just to clarify the distinction, so I do biz dev for Compound Labs. The protocol itself, just runs fully decentralized. My main job is to really just be a resource for different businesses, like those exchanges and custodians. Anyone who's looking to build some new type of interface or experience on top of the protocol, and helping them kind of think through the use cases and what that final offering can look like. So yeah, it's been a ton of fun. There's so many talented developers who are building those experiences. So it's really just been a pleasure to connect with people in the community.
Okay, thank you. All right, fantastic. We have to wrap this. I don't want to wrap it up. I want to keep going, but we do need to wrap it up. Nick, thank you so much for a fantastic presentation, very insightful. Hopefully we can get the deck from you and distribute it out to our RSVP list, which is right now about 1,500 people. Hopefully somebody will reach out to you to get the deck, and we're going to compile it and get it out. So thank you for your time, Nick. Really appreciate it. Anything else you want to say before you go?
No, I think that's it. Thanks for having me. And yeah, glad for this opportunity. Thanks so much.
Great. Take care. Have a great day.